Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And with me today, I am joined by Mike Roeder. Mike, welcome to the podcast.
Thank you so much, Whitney, for having me on the show. I appreciate it. Looking forward to it.
Awesome. Well, before we dive into Keystone Farms, 90 units in Nashville, Tennessee, tell us a little bit about yourself, how you got into multifamily investing, and where you're at today.
Yeah, great question. So I started my real estate career back in 2008 in the single family space, invested in a few single family rental properties. It really wasn't working for me. It basically added another job to my plate. And at that point, my business partner was investing in apartment complexes out in Washington and then in Minnesota, where we both grew up. And so we had been chatting. He was, explaining all the advantages of multifamily. So we decided to go into business together. We bought an 8-unit together, bought a 20-unit together. And then shortly after that, because those projects were doing so well, we formed our company called Granite Towers Equity Group and started syndicating projects, which means, pooling capital together to buy larger apartment complexes.
Awesome. Well, let's dive into the details of this property. So it's the name of it's Keystone Farms, 90 units, Nashville, Tennessee. You closed on it, I believe you said July 2022. Let's back up the timeline a little bit and tell us how you got it under contract. Like, where did you find it? How did you first uncover this deal?
Yeah, so this deal was fully listed by a broker in Nashville. We had built out a really good relationship with them over, a 3-year period. And when it came to market, we knew that we loved the location, we loved the asset, we already knew of it. And, we dove into the underwriting. The numbers made sense for us and how we underwrite deals. And so we ended up offering on the property. The property did go into a call for offers and then into a best and final round. And I think what really made us stick out was our buyer interview call. The owners that sold this property to us were one of the biggest groups in the United States. They own, the most real estate in the United States. And so they were really looking for someone that could hold up to their word, that could close the transaction, that would be easy to work with. Also, that would put a significant amount of hard money down day one. And we hit all those metrics. I think we knocked it out of the park on that buyer interview call, and we were able to land the project.
Well, let's talk about some of those metrics. How did you craft? Let's talk about the specific deals of how you crafted the offer, how much earnest money you put down, how much went hard from day one. Let's talk about those specifics.
Yep. So in our initial LOI and on our PSA, we had $250,000 hard day one. So basically the day that we signed the purchase sale agreement, that $250,000 was no longer ours. It would get credited to the purchase price, but if we backed out on the transaction, those funds would go to the seller. We had a 21-day due diligence period. And, backing up, the way that we can feel comfortable putting that much hard money down day one is by getting our team on site and, taking a look at all the major components of the property before we sign the PSA. So we had our contractor go out, walk the property, take a look at the foundation, take a look at the roof, the exterior, and just make sure that there were no major flaws that would, make us back out of this deal. But again,
and was that outside of actually doing an inspection? Was this just kind of like a walkthrough of the property?
Correct, exactly. So this was before we signed the PSA, before we did the inspection. We toured the asset ourselves, and then we brought our contractor and our property manager along. So that way we'd have a really good feel going into signing that PSA.
And what was the purchase price of the property?
Yep. So purchase price was a bit over 24 million is what we purchased the project for.
All right. So 24 million, 250,000 down hard day one, 21-day due diligence. And then how much time did you have for closing?
So we had a 60-day period, which is very typical in our PSAs. We also put in a couple of 2-week extensions, which we put additional hard money down if we ever need to use those. Very rarely do we have to use those extensions. On this one, we were able to close it in, I believe, about 50 days, so a pretty quick period. And then, a couple of contingencies that we always place in our PSA, title. So if the title doesn't come back clean, we can get our earnest money back if we back out. Also, seller default. if the seller defaults and all of a sudden they decide that they don't want to sell the property to you, you want to be able to get your earnest money back. So make sure to put that in there. And then also environmental, if the phase one comes back and there's some environmental issues, we want to be able to get out of that contract as well. We did not have a financing contingency at all. That's very typical for us. We never throw that in. I know things are, changing quite rapidly as the market shifts from a seller's market to a buyer market. So some of these items, we may tweak a little bit nowadays.
Okay. So, you mentioned that you felt like you closed it on your buyer's call, right?
Mm-hmm.
Now, you said there was a call for offers. So how many other groups were you competing against?
This one, I believe that there were 7 or 8 different groups that went into the call for offers, into the best and final round. So it was a pretty hefty amount of people, going into that best and final round. And I believe it was 12 or so offers total that came in on the initial round.
And then what clinched the deal for you? What do you think?
Yeah, so again, I think it was the buyer interview. We go through, why we like the deal. We talk about the debt, we talk about the equity, basically every in and out of, how we have the deal underwritten. And I think that really stood out. And then also our track record, anytime that you can paint a very good picture on what you've done in the past, that's going to help you substantially especially with sellers getting comfortable selling to you. So we've never backed out of a deal. We've never retraded a deal. Very, very important. And obviously you can't always have that happen that way, but we strive to make that a goal of ours on every transaction. And, fast forward to today, it's even more important that you do what you say you're going to do and that these sellers pick, the best buyer that's actually going to close the transaction. So all of those pieces of information are even more crucial in today's environment.
All right. So you got the property under contract. How quickly were you there for due diligence? And did you get to walk every single unit?
We did. So we were on site within about a week to do our due diligence. We bring in all the contractors, our property manager. We strive to walk every single unit. On this property, I believe we had 6 units that either the tenant had changed the locks or they were claiming they had COVID and that we couldn't go into the unit. And what we do in that circumstance is we just follow up a week later, have our team go back out and walk those units, or 2 weeks later. So we were able to get into every unit within a couple week period. And we have our property management team walk every unit. We also have our contractors walk every unit and, really lay out what needs to be done in the units, what condition they're in, and so on.
All right. So let's talk about that. Did you find any surprises like on the physical inspection and the financial inspection, and help us kind of stitch together what your business plan is here?
Yep, great question. So our business plan, we have about $1.3 million that we are sticking into this asset. About half of it was going to interior unit renovations, so about $647,000. And then $670,000 was going to the exterior amenities and deferred maintenance. Major hiccups or unforeseen circumstances, really the only thing that popped up, which, we were aware of before we put it under PSA, was there was basically a landslide on one of the hills that was bordering the property. So the earth was unstable, there was groundwater coming up and it had slid down, they removed the dirt, but it was still unstable. So we had a budget about $150,000 to have, some backhoes come in, dig it all up. They put some drainage through the hill and, they've since fixed it. So that has worked really well. And when we got into the transaction, we were actually told that lightning had hit the hill and that's why it had slid, which obviously wasn't the case. It wasn't a one-off circumstance. It was something that would have continued to keep happening. So I would say that was the biggest, unknown prior to us going under contract. But again, our contractor did figure that out before we signed the PSA. And then the other, slight hiccup was when we took over on this asset, there were a handful of tenants that needed to be evicted. And we found that on a lot of assets, sellers many times will place tenants that might not be fully qualified. And, you may have to evict those tenants. So just make sure to, be conservative with your underwriting on the vacancy and the occupancy, especially for that first year as you go to clean out some of the tenants that aren't paying their rent.
And this wasn't something that you found on the financial due diligence?
So we did. We were well aware. We were hoping obviously that we'd be able to get them to pay. A lot of them that didn't happen, so we had to clean it out. Luckily, we were able to rent those units out very quickly. And I know you had asked about our business plan, so I can kind of run through that. Again, for the interior units, we're putting in granite countertops, tech package, washer and dryers and select units, and then just your basic turn. And then for the exterior and amenities, we completely revamped the gym. It was very dated. So we basically replaced the flooring. We put a sauna in, put some new gym equipment. We also did a full office reno. The office was extremely dated. And, that's the first thing that prospective tenants see when they step into the property. It's the first impression. So very, very important that you get it right. Deferred maintenance, we put in a new playground. The playground was decrepit. So very great for, the kids that live on property and also for prospective tenants that are touring the deal. Put in a dog park, new signage, which really helps, with traffic. And then we fixed that hillside. And then we also installed some fenced in yards, which, we've seen a great demand for in Nashville and other markets that we're in.
Did you, with the whole drainage issue on the hill that was sliding, or the part of the property that was sliding, did you have any issues with the insurance in getting a policy in place before closing?
That's interesting. We did not. They did not ask about, ground movement around the site. And when they came out and did the inspection, I believe we had that work underway already, but we never got a question about that, which was, kind of surprising.
All right. Well, let's move on to the financial part of the deal. Did you guys acquire a loan for any portion of the deal?
We did. So we did a Lifeco loan, non-recourse, 7 years fixed, 30 months of minimum interest. So that's our prepayment penalty. After we get past 30 months, there's no prepay. 64% leverage, which is really in tune with what we're doing today. We're doing a little bit lower leverage loans to mitigate the risk. Rate was 5.57%, so a decent rate. And then we had 4 years of interest only. So we were really excited about that loan. It kind of hits all the metrics that we look for in our debt placement.
Okay. And then talk to us, how much, you said you got 64% loan to value or loan to cost?
64% loan to value. And then we did all unfinanced rehab. So all the rehab we raised, completely liquid in the bank. So that way we can call audibles if we need to.
All right. And then, so how much did you end up capital raising for this deal?
Yeah, capital raise on this one was just over $12 million of equity that we raised on this one.
Okay. And how did you structure that with your limited partners?
Yeah, great question. So we always do an 80-20 split. So we take 20% of the equity in the cash flow, and then our investors take 80%. And so that's our typical structure on our deals. And then we also take an asset management fee and acquisition fee.
Do you guys do a preferred return?
We do not. It's a straight 80-20 split, so no preferred returns on our deals.
Okay. And then let's talk about the fees. You said you did an acquisition and asset management. What were your fee ranges there?
Yep, great question. So our asset management fee, we typically take 1.5% to 2%, which is very typical, in the industry. On this one, we took 1.5%. And then for our acquisition fee, that's really there to, pay our team for finding the deal, for building the relationships, for putting together the team, for getting the deal past the finish line. And we took a 2% acquisition fee on this one.
Okay. And let's talk about how the general partnership is structured. Is it how many general partners are in the general partnership?
Yep, great question. So on this one, we have 5 general partners. So we have myself and Dan that are part of Granite Towers Equity Group. We also have Steve Woolworth, Steve Nabity, and then Ruth. So 3 additional general partners.
Okay. And then how did you guys split up the general partnership?
That's a great question. So the bulk of the general partnership went to, the general partners that found the deal and that are asset managing the deal. And then a smaller portion was given to the general partners that, are raising capital and that are also on the weekly management calls and doing some smaller tasks for the deal.
Okay. And then the earnest money, since you had 256,000 down hard from, or 250,000 down hard from day one, how did you guys front that money yourself, raise it from investors? How did you pre-seed that money?
Yep, great question. So all of the hard funds or earnest money come from us as the general partners. So we don't source that from our limited partners at all. And Dan and I typically handle the bulk of the earnest money, and then the other general partners will kick in as well, depending upon the circumstance.
Okay, awesome. Well, you said you had a little bit of hiccup at takeover with trying to get those tenants to pay that you had uncovered during the due diligence period. Were there any other hiccups after takeover?
Any other hiccups after takeover? It's actually been very, very smooth on this one. I would say dealing with contractors, that's always an interesting, situation. You have issues that arise. Maybe they don't do the job like they said they were going to do, or maybe, the timelines get pushed out. So we're always trying to stay on top of our contractors that we're working with as much as possible. So that way things go smoothly and they get done in a timely manner. But other than that, there really has been no other hiccups on this one. So.
And are you working with contractors that you've worked with before? Are these through your property management company?
This is a contractor that we've worked with before in Nashville. So we do have extensive experience with them. The first deal that we worked with them on in Nashville, the timelines were pushed quite significantly. We had a lot of invoicing issues, and we've been able to work through that with them, on future transactions, but it was a work in progress.
As I feel it always is with contractors.
Exactly. They can do a very good job, but man, there are a lot of contractors out there that are very disorganized.
Absolutely. All right. Well, in wrapping up, what did you find that was easy that you thought was going to be more difficult? And then what actually ended up being more difficult that you thought was going to be a little easier?
Yeah, so I would say on the front end, landing a deal from this large of a seller, we thought it was going to be much more tough. We have about 2,500 units under management, so we're still fairly small in the scheme of things. And so I thought that was actually easier than we thought it was going to be, especially after that buyer interview call. And then something that's, been harder than we thought. I think the one other thing that I didn't mention is when we stepped into this asset, we brought on a new on-site manager. We were excited about her, and occupancy dipped for the first 60 days. On top of the evictions, we just weren't getting the leases that we needed to. And so we had to fire that on-site manager and bring someone else in, some other talent, and occupancy, went from about 82% up to 100% over a 45-day period. And so, that was a little tough, and that happens. Sometimes you just don't have the right people in place, and you need to make changes very, very quickly if that is indeed the issue. So, that was one thing that was a little bit harder than we thought it was going to be, because we did think we had someone great, a great fit for the property when she first stepped in.
Yeah. What did they say? Hire slow, fire fast, right?
Yep, that's exactly right. You got that.
Well, Mike, thank you so much for sharing your knowledge and expertise with us here today. If people want to find out more about you and what you're doing, where can they do so?
Yeah, so if you go to granitetowersequitygroup.com, that's our website. You can fill out our contact us form, and we'll keep you in the loop with what we have going on in the future. And then we also have a free ebook on passive investing, how to successfully passive invest, on our website as well. You can download that if that would help.
Awesome. Well, Mike, again, thank you for your time here today, and we look forward to hearing about your future deals.
Thank you so much, Whitney. It's been a blast.